I'm Jay Bornstein, Treasurer of Echelon. I've prepared this short video about tax-wise charitable giving. December is a time of the year when many of us stop and give thanks by doing volunteer work or opening up our checkbooks to those people and organizations that could use our support. Congress has always used the tax law to incentivize charitable giving, so I wanted to give everyone some highlights. If you have questions, you can email me at the address on the slide or talk to your own tax advisor. But first, some general disclaimers. What I'm talking about can't be viewed as tax advice to you, meaning you can't rely on this information to avoid tax penalties. Everyone's tax situation is unique and dependent on your own facts and numbers. Tax laws are always in a state of flux, and they're especially this year end. So before taking any action, you should consider your own situation and the state of the tax law. And again, I recommend discussing things with your tax advisor. We're going to talk about 5 different ideas today, and we're going to spend about 8 minutes doing it. I'm not going to read the slides to you. I'll be commenting on them. So follow along on the slides. The information that we're talking about today applies to all charitable contributions, not just donations to Echelon. We hope that you include us in your year-end charitable plans. Some of the ideas, like bunching charitable contributions, are a year-to-year exercise. Others, like the donating of appreciated securities or using the money in your IRA, are ideas that apply to every year. So first, let's talk about bunching itemized deductions. And here is one time where you need to watch the proposed tax law because things could change before year end. In the 2017 Tax Act, a limit was put on how much can be deducted for state and local taxes. That limit was $10,000. That meant that many people that couldn't fully deduct real estate taxes or state and local income taxes. And because of that, more people were directed towards the standard deduction. That especially applied to older couples without a mortgage, which fits the profile of many of our synagogue members. So older couples, rather than claiming deductions for interest, taxes, contributions, and medical expenses, would use the standard deduction. If your actual deductions total $20,000, you got more benefit from the standard deduction. For single taxpayers, the spread between the $10,000 state and local tax limit and the $12,000 standard deduction was smaller, but still many single individuals use the standard deduction. The planning strategy is to time your deductions between years so that you can alternate between the standard deduction and itemized deductions. Let's see how this works. A hypothetical married couple with $10,000 of state and local taxes, a house with a mortgage, and annual contributions of $6,000. Their taxes are limited to a $10,000 deduction, mortgage interest of $12,000, and $6,000 in contributions makes $28,000 of itemized deductions per year. With no bunching over 2 years, they would claim $56,000 of itemized deductions. Let's say they could time their charitable contributions by accelerating $4,000 from 2022 into 2021. This year, they'd have $32,000 of deductions, and next year they would take the $25,900 standard deduction in lieu of their actual deductions, which would only be $22,000 in that year. So between the 2 years, they get an additional $1,900 of deductions. This could save $600 or more in taxes. So that's not a bad return for just sending out a few checks early. Now, in the case of Echelon, many of us have zero balances in our account. You can still use this technique. You can make a prepayment of next year's items, such as your dues, your sponsorship of our fundraiser, or similar items. We'll hold your money on account. The deduction, the donation, will appear in this year's tax letter that we will send out in January. A similar approach applies with respect to tax rates. They are graduated. Years ago, there were many more tax brackets. The difference from one bracket to the next was smaller, it was 1 or 2 percentage points. Now there's just a few tax brackets, but the jumps between them are much bigger. So the tax difference is huge. Your tax rate can go up 10 percentage points with a mere additional dollar of income. It's a marginal rate, but it's something we want to pay attention to. So if your income has gone up in 2021, take a look at the tax rate that you'll be subject to this year. Possibly a higher rate will apply to you than normal. If you're normally in the 12% bracket or the 24% bracket, and this year it'll be higher, you can pre-fund contributions to use up, get the benefit of the deductions in that higher tax bracket. The same $1,000 donation check in December versus January can cost you either $780 in the 22% bracket or $880 in the 12% bracket. So take stock of your taxes before year end and move dollars around. It's possible that going through this exercise, you may want to delay contributions from December 21 to January 2022 because you expect your income to be higher next year. Now, unlike it for me to recommend that you slow down contributions to Beth Shalom. So if this applies to you and you were planning on paying your bill in December, pay it in early January. Don't wait it out till the springtime. In the first couple months of the year, our cash flow at Beth Shalom is typically low and we could use the money. So thanks for your help with that. A couple more points on this topic. You can control your income by accelerating or decelerating things. You can use income or expenses to the extent that you have items that have flexibility. Contributions give you a lot of flexibility because there's no per se deadlines on them. If you're short on cash or if you just like to accumulate airline miles, credit card charges are deductible when the charge is incurred. That's when it's posted to your account, not when the bill is paid, even if you don't pay your bill in full when it's due. Let's talk about appreciated securities and contributions. Here, the tax law is very donor friendly. If you own a stock and sell it, if there's a profit, the tax rate on the gain can be as high as 23.8% plus state tax. But if you give that stock away, you get a tax deduction for the full value and don't pay tax on the gain. This is like free money. Emily in our office can help you transfer stock to Beth Shalom. We have an account at Merrill Lynch that we use for this purpose. That's how you have to do it. You have to transfer the stock to us. Don't sell the stock and send us the money. We have to receive the stock. We will sell the stock immediately and reinvest the funds in accordance with our investment policy. So how does this work? Let's say you had shares of stock now worth $12,000 and you were ready to sell the stock and donate the net after-tax proceeds to Beth Shalom. You sell the shares, pay tax on the gain, and let's say the rate is 20%. So net after taxes, you receive $10,400. You send that money to Beth Shalom. Thank you very much. You get a tax deduction for the $10,400, save $2,496 in taxes. So your net cost is $11,104. Let's say you donate the stock to Beth Shalom. You don't have any capital gain taxes on the sale. We get the full $12,000. You save $2,880 in taxes. So your net cost now drops to $9,120. We get more. It costs you after tax less. We both win. This is a very effective way to donate money. And you don't have to do this with tens of thousands of dollars. We do this with all sizes. Many of our congregants use this strategy. Again, if it creates a credit balance in your account, we'll hold the money and apply it to future bills, but you will get a tax deduction in the year of the transfer. Call Emily in the office to help facilitate the transfer and allow some time for this to happen before year end. Since we have an older congregation, I want to talk about individual retirement accounts and qualified charitable distributions, abbreviated as QCDs. If you're over 70 and a half, you can use money in your IRA to make contributions, and you don't have to pay tax on the funds you use. Even better, if you're over 72, you can use these contributions to reduce the amount of money you are required to take out of your IRA every year. The way this works is that you have your IRA custodian. That's the bank, the brokerage firm, or mutual fund house where you keep your IRA. Write a check directly to us. Don't get the check made out to you. If you do that, you will have to pay tax on the income, even if you give us the money. Now, you don't get to deduct this contribution. People ask me that every year, and I say there's no double dipping, but this approach can save you money in other ways. There's a series of tax rules that are based on your income, such as when you have to pay tax on Social Security premiums and how much you have to pay, how much of your stimulus checks you're entitled to under the CARES Act and similar legislation. All these things are a function of your income. So this approach eliminates this money from your income. So it's a very effective way to save money. The most common savings has to do with Medicare premiums. Medicare premiums are based on your age. So keeping your income low can lower your Medicare premiums. The tax law used to be unsteady in this area. Now that was made permanent. So you can include this in your annual planning. We see many of our congregants using this approach to pay their bills to the synagogue every year. Thank you for that. If you've already done your full required minimum distribution for 2021, you can still use this for charitable contributions this year, or you can wait until January and use this technique to reduce next year's required minimum distribution. Finally, since I'm a CPA, I do want to remind everyone who's required to take money out of their IRAs to make sure that they do it this year. Last year, Congress gave us a holiday due to the pandemic, but the RMD requirement is back for the year. So please don't forget to take care of this. Finally, another popular item, and you'll read about these a lot in the paper this time of year, is the donor advised fund. Here you have a chance to give money away and get a tax deduction without deciding who or where you want the money to go. These are like private foundations, but without the paperwork and potential public disclosures. Many of our congregants use these as well. You can set them up with large banks and brokerage firms, and Jewish Federation of Philadelphia also sponsors their own donor advised fund. And just the other day, yesterday, we got a flyer in the mail from Jewish Federation talking about their donor advised funds. They raise significant funds this way. You put the money in and you don't have to immediately distribute it. You can distribute it over a series of years, anytime you want. I have one of these, the Bornstein Family Fund. We keep our money invested at Charles Schwab. And when I want to make a contribution, I go online, and in 2 to 5 days, the charity has a check from our family fund. In the interest of time, I don't want to say much more about these. You can read about them. Again, there's lots of articles in the paper, or call Federation Endowments, and they will send you information about their sponsored donor advised funds. That's all I wanted to cover today. Thanks so much for your attention. If you have any general questions, feel free to reach out to me. If you have specific questions about your personal situation, it's best you talk to your own tax advisor. Proper tax planning allows us to direct more of our assets to charitable organizations of our own choosing. That's the goal of the tax laws, so it's in everyone's best interest to know the rules to maximize your benefits. Thanks for your support of our wonderful congregation.